Welcome to News You Can Use in Your Personal and Professional Lives. I'm Dan Finn. I am a nearly 30-year veteran of the structured settlements and income annuity industries. I'm credentialed in several areas of relevant expertise, come recommended and certified from a few prestigious organizations, and I'm proud to have assisted thousands of people over the years with their fixed income solutions involving hundreds of millions of dollars, and I thank you for the opportunity to be of service to you today. Today's session is entitled Sequence of Returns Risk and its Impact on Your Future. I put this together for anybody who's seeking to take more control of their own financial future. I know your time's valuable, so I'll keep this session brief. I'll begin with a definition of sequence of returns risk, move through to some history of the market and its impact on your money. I'll then offer you a solution and end with some final thoughts. According to Investopedia, sequence of returns risk becomes a danger when people take withdrawals from their underlying investments. The sequence of these investment returns poses a very serious potential risk to retirees who, in most cases, need this money to last them the rest of their lives. In addition to retirees, however, I'm going to add another classification of people, those anticipating personal injury settlements. Because not only does this income need to last both groups of these people for a lifetime, their ability to generate future income from employment is not what it once was. They can't afford to take risks with this money because once it's gone, they have nothing left. Who benefits most from this session? Well, you will if you are in or close to retirement, if you are a plaintiff in a personal injury lawsuit, if you are a contingency fee-based attorney whose income might fluctuate from year to year, or if you're just anybody who wants to take a little more control over your own financial future. Here's a chart showing 100 years of stock market activity. Most of us have been led to believe that the market generally returns 8 to 10% average per year. And while that's certainly true if you have a long enough time horizon, the market has always trended upward. There are definitely clearly periods of time when the market jumps around quite a bit. There's a lot of peaks, there's a lot of valleys along the way. So while the trend might be upward, individuals who entered a market during a peak and don't have 100 years to let their nest egg grow, or even 30 years to let their nest egg grow, can find themselves on the losing end of this market roller coaster. Using that chart from the previous slide, let's take a look at what would have happened had you invested $100,000 at various peaks in the market. How long would it have taken you to earn 1 penny more than $100,000? In 1915, the market peaked in December, and it was almost 12 years before it returned to the same level. Just before the Great Depression, the market peaked, and investors who didn't lose everything and stayed in the market had to wait nearly 20 years just to break even. In 1966, it took nearly 30 years for investors to turn a profit. In January 2000, a little more than 13 years. And then just last January, the market hit an all-time high, and it's still too early to know yet how long this current valley is going to last till the market returns to those levels. It could happen tomorrow, next week, next month. It might have happened already by the time you're watching this, could happen next year or 10 years from now. But my question to you is this: what if 2018 turns out to be 1966? Are you willing to bet your life and your entire future that luck will be on your side? This chart, showing the historical annual returns of the S&P 500, reveals that the market has a history of performing positively about 2/3 of the time, but 1/3 of the time the market is negative, something to think about when you're tying up your life savings. These next few slides are going to show you the impact of the sequence of returns risk on your money. Over here on the left, we have a spreadsheet summarizing the Dow Jones Industrial Average returns from 1994 to 2018. In 1994, the market returned just over 2%, and last year the market was negative by a little more than 5%. Add all these years up, however, and your average annual return is 8.78%. This assumes, by the way, a buy and hold strategy, doesn't factor in taxes or management fees and expenses. Simply make a deposit, earn what you're going to earn, and end up with a sum of money at the end. These next two spreadsheets show what would have happened if these exact same returns occurred in different years. This middle one rearranges the returns so the worst years occur first and the last one's best, and this one shows the best years occurring first and the worst ones last. This exercise highlights the fact that timing of investment returns during the accumulation phase to some extent aren't really critical. Either way, you're still going to average 8.78%. Here, $500,000 deposited at the beginning of the term in 1994 with no withdrawals would have left the person earning 8.78% on average, ending after 25 years with a little more than $3.1 million. And even in the worst to first scenario, that person still ends up with $3.1 million, as does the best to first individual. This exercise highlights the fact that timing of investment returns during the accumulation phase to some extent aren't really critical. In all three cases, the average is still 8.78%, and they all end up with the same amount of money. However, once you begin drawing down funds from the investment, things change. This is where it gets risky. An individual who began drawing down $20,000 a year in 1994 did quite well. $20,000 we'll just assume for the moment is 4% of the principal, which is the number that many financial planners will suggest using as a starting point to make sure that your nest egg lasts you for the rest of your life, or at least for 30 years. 1994 to 2018, you're withdrawing $20,000. You still end up with a little under $2 million. But look what would have happened if this same person was unfortunate enough to begin drawing down at, say, the beginning of the Great Depression or the Great Recession, when the funds were when the market was in a prolonged downtrend. They would have been completely broke after 13 years. For someone who's planning to use this money to live off of for the rest of their lives, they'd now be in a very unhappy situation. Remember, down markets occur 1/3 of the time, and there's no way to predict with any certainty when the market might head south. And over here, if we rearrange the returns with the best years first, this person does about $500,000 better than the person on your left. But again, focusing on this middle one, what happens if 2018 ends up being 1966, and this is the year you're retiring or settling a personal injury claim? So to summarize, the sequence of returns has the potential to wreak significant havoc on your future. Negative or low returns, particularly during the first few years of retirement or moving forward after a personal injury settlement, can completely destabilize your future and leave you destitute. Market is negative 1/3 of the time. My question to you is, would you board a plane that only had a 67% chance of landing? Your future is quite literally that important. It is a matter of life or death if this is the money that you have to live off of, that you're depending on for your rent, mortgage payment, medicine, or things that you need to take care of yourself in retirement or after a personal injury settlement. One solution to this problem, the sequence of returns risk, is structured settlements and income annuities. While you have little control over your money when you're invested in the market, these two options allow you to take full control over your own future, because your future is 100% guaranteed. The future income is 100% guaranteed. The income is tax-free or tax-deferred. You eliminate the uncertainty of the market. Statistically, people with annuities live longer than people that don't have annuities. You don't have to stress or fret or contemplate jumping off of a bridge if you see the market going into another tailspin. And finally, you'll be happier. Statistics show that people are happier that have annuities than people that don't have annuities. My question now again to you, rephrased, would you board a plane that had a 100% chance of landing? A couple final thoughts. Some longevity studies. Living too long is actually a major financial risk now. Even though life expectancies have seemed to have peaked for now, it's still a major financial risk. Only lifetime income annuities can protect individuals in an efficient way because income annuities provide secure income for 25 to 40% less money than traditional means and are the most cost-effective and least risky asset class for generating retirement income for life, which, by the way, is a top retirement goal for 97% of baby boomers. These are the published findings of Investing Your Lump Sum at Retirement, a published policy brief research paper co-authored by Professors Babel and Merrill, who are both fellows of the Wharton Financial Institution Center. This is a great paper, surprisingly very easy to read given the complex nature of the topic, and I think you'll find it very helpful in planning for your own future. I highly recommend it. Well, that's it. Hope you found this information helpful. You're invited to join us on our social media platforms, and be sure to let us know if you have any questions or if there's ever anything we can do to help you secure your own financial future. Thank you again for the opportunity to be of service to you, and have a great day. Thank you.